Welcome to the Deep Dive, where we take the crucial documents, earnings reports, research notes, and CEO commentary and synthesize the signal from the noise, giving you the shortcut to being well-informed. Today, our focus is Champions Oncology, following their release of Q2 fiscal year 2026 results after the market closed yesterday.
And this one is it's a really interesting story built around a central piece of dissonance.
Dissonance is a good word for it.
Yeah, because on paper, these results were stellar. I mean, massive beats across the board, a great strategic story from management. But then you look at the market reaction, a huge after-hours rally, completely erased by a sell-off the next day.
So our mission today is to figure out what anxieties, what fundamental worries completely overshadowed what looks like a genuinely strong operational quarter.
Exactly. Find the signal.
Okay, let's start there. Let's start with the undeniable good news. Give us the snapshot of the financials that sent the stock flying, at least initially. What did they deliver?
Well, they delivered a really substantial beat on pretty much every key metric.
Yeah.
It signals that the operational recovery is, it's really taking hold. Revenue came in at $15 million.
$15 million. And to put that in perspective, consensus was looking for what?
Consensus was around 14.32 million.
Yeah.
So, it's a comfortable beat, represents about 11.5% year-over-year growth.
And that top line beat flowed right down to the bottom line, which I think was the real shocker for people.
That was the real surprise.
Yeah.
The street was expecting essentially zero.
Right, break even.
Yeah, adjusted EPS consensus was flat, $0. Champions reported a positive 6 cents per share, diluted. GAAP EPS was also positive at 2 cents.
And what about EBITDA?
Adjusted EBITDA came in strong at about $843,000.
Yeah.
So look, this isn't just a small beat. This is real leverage. It shows that as volume comes back, the model really, really works.
And they seem to be sticking to their guns. They reiterated those 3 core goals for the year, right?
They did. They were very clear. Goal 1, achieve year-on-year revenue growth. Check. Goal 2, keep investing in the data platform. We'll get to that. And goal 3, and this is the big one for investors, maintain full-year positive adjusted EBITDA without any shareholder dilution.
So this quarter really gives them a strong foundation to hit all 3 of those.
It absolutely does, especially that positive EBITDA goal.
So let's talk about how they got to that $15 million revenue number. Management said it wasn't just, higher prices. It was about execution and a sort of shift in the biopharma world.
Exactly. And this is the signal we need to really hone in on. They said the revenue lift was mainly from stronger conversion of booked work. And that was driven by a normalization in study cancellations.
Ah, the cancellations. That's been a killer for the last, 18 months?
It's been a killer.
Yeah.
Especially for smaller biotechs. They'd book a study, run into financing problems or a bad trial result, and poof, the work gets canceled midstream.
So Champions is seeing fewer cancellations. What does that tell you about the broader funding environment out there?
It suggests things are stabilizing. It's a huge tell. It means the clients booking work now are more financially sound. The money's there. The research is committed. That stability is maybe the most important macro takeaway for the whole call.
So demand is getting more reliable. And reliable demand plus cost discipline, well, that's operating leverage 101. That brings us to margins.
Yes.
Hitting 6 cents when you were expected to be flat shows huge leverage. The question is, how durable are those high margins?
The leverage was, it was really impressive. The oncology services gross margin expanded to 52%.
52. And that's up from, 45% a year ago?
A full 7 percentage points.
Yeah.
And management was explicit about this. They framed that 50 to 52% range as like the new normal. That's what they expect for the core services business going forward. This isn't a one-off.
So that's a structural floor they're building.
It is. Income from operations was positive, $185,000. It just confirms the whole structure is scalable.
Okay, a 52% gross margin floor on the core business. That's a ton of cash generation potential. And that leads us to the strategy, which is all about reinvesting that cash into what's next. They talked about 2 big pillars, radiolabeling and the data platform. Let's start with radiolabeling. Why is that so important right now?
Radiolabeling is an absolute differentiator in a super hot field, radiopharmaceuticals.
Right, the drugs that are basically tiny targeted radiation therapies.
You got it. And to test these drugs before they go into humans, you need these highly specialized, very complex labs and workflows to handle the radioactive compound safely. Champions highlighted that they are one of the very few labs approved to do this kind of high barrier work.
So bringing that specialization in-house, what does that do? Is it just about adding a new revenue stream, or does it also help that 52% margin we were just talking about?
It does both, but the margin impact is key. Before, when they needed this work done, they had to outsource it to another lab. That's expensive. It eats into your margin.
Oh.
By doing it themselves, they keep that profit. It increases the gross margin on those specific high-value projects, and it builds a higher wall around their business. It's a great move.
A powerful dual play growth and profitability. Okay, that's one pillar. The second one is the data platform push. They're trying to be more than just a lab for hire.
Exactly. They want to move beyond being just a CRO, a contract research organization, and start selling deep translational insights, target identification. That means huge investments in sequencing and data infrastructure.
And to signal how serious they are, they made a really big hire.
A very strategic hire. Dr. Tammer Farid, who came from Illumina, is the new general manager of the data business.
And why is an ex-Illumina exec so significant here?
Because it screams commercialization. Dr. Farid doesn't just have the deep science and sequencing background from Illumina. He also spent time at Boston Consulting Group.
Ah, so he's not just a scientist, he's a strategist.
He's a business builder. They hired someone to structure, price, and sell a scalable data product on a global level. It shows they see data as a whole new business, not just some academic add-on to their lab services.
Okay, you can't make a pivot like this without spending some money, and that's the trade-off the market is wrestling with. OpEx, operating expenses, went up quite a bit.
It did. It rose by about $2 million year over year. And that's the friction point in this whole story.
So where did that $2 million go?
Okay, so about 900,000 of it was an increase in R&D. That's directly tied to building out that future we just talked about. More sequencing capacity, developing the data platform, integrating the radiolabeling stuff. You have to spend that money.
That's the cost of building the moat. What about the rest? About 800,000 was in G&A, which investors never like to see.
Right, general and administrative. Management said that was mostly for IT infrastructure and costs around leadership transitions, like bringing on Dr. Farid.
So necessary upgrades.
I think so. I mean, if you're building a global data business with sensitive patient data, you have to spend on security, on cloud infrastructure, on compliance.
Mm-hmm.
It's unavoidable. They did suggest some of it might be temporary, but for now, it's a cost of doing business.
Okay, so this is an exciting but expensive self-funded pivot. But the biggest cloud hanging over this whole call, and I think what really drove that sell-off, is Correlia.
Ah, Correlia, the wholly owned subsidiary for target discovery.
What is the latest on their attempt to spin that out and get it off their books?
Correlia is. It's the definition of a necessary evil right now. It's the side project that's draining cash from the main business. Management said they are making solid progress in VC funding talks, but the timeline is it's frustratingly long.
How long?
They said Correlia will stay on their P&L, so continuing to be a drag potentially through the end of fiscal year 2027.
2027. Wow, that's a long runway. Doesn't that sort of imply that they're having trouble getting the valuation they want, or that VCs are maybe a little skeptical?
That is precisely the skepticism that's now baked into the stock price. I mean, the idea is sound. Once Correlia gets external funding, champions can redirect all that cash into the high-margin data business. But the market is focused on the cost of the delay. Every single quarter Correlia stays on the books is a drain.
Speaking of drains, let's look at the cash flow for the quarter, because that was another point of pressure.
It was. The company used about $1.9 million in cash from operating activities.
Which looks bad on the surface.
It does, but this wasn't from bad operations. It was due to an accounting thing related to deferred revenue.
Okay, can you break that down for us? Deferred revenue is a piece of jargon that always confuses people.
Sure. Think of it this way. A client paid Champions for a big project, say a year ago. Champions got all the cash then.
Right, the cash is already in the bank from a prior period.
Exactly. But accounting rules say you can only recognize the revenue on your income statement as you actually perform the work. So this quarter, they recognized a bunch of revenue for work they'd already been paid for.
So revenue shows up on the P&L, but no new cash actually comes into the bank account this quarter.
Correct. So it creates this temporary negative effect on operating cash flow. It's a timing issue, not a solvency issue. But, you combine that with the higher OpEx, and it makes investors who are focused on near-term cash generation pretty nervous.
So with this long transition, high OpEx, the Correlia drag, what does their overall financial stability look like? Are they in any trouble?
No, the balance sheet is solid. That's their buffer. They ended the quarter with $8.5 million in cash and critically zero debt. That lets them fund this whole thing themselves without having to sell stock, which is one of their main goals.
Okay, let's circle back to the market reaction because this is where it gets really interesting. Superb execution, great margins, and yet the enthusiasm just vanished. The stock surges 16% after hours.
And then closes the next day down almost 14%. It's just a classic case of whiplash.
So what signal did the market ultimately glom onto to justify that reversal?
The market shifted from celebrating the beat to fixating on the execution timeline. If you listen to the analyst Q&A, the questions were all about the durability of demand, specifically about RFP velocity.
Okay, RFP, request for proposal. For our listeners, what is RFP velocity and why is it so critical here?
It's just a measure of new business coming in the door. How many new clients are asking for project quotes? The quarterly beat proved they can execute existing work brilliantly and get that 52% margin.
But investors need to see that the pipeline is refilling behind it.
Exactly. The market is worried that while cancellations have stopped, the rate of new big contracts isn't accelerating fast enough to guarantee that double-digit growth continues. They want to see the funnel getting full again, and quickly.
So that uncertainty about new bookings plus the internal spending, it creates a perfect storm of caution.
It does. And the second piece was that OpEx and cash conversion story we just talked about. The market sees the 1.9 million cash burn, sees the rising OpEx, and basically says, we don't want to fund a pivot that's going to chew through cash for 2 years.
And then you layer on the Correlia uncertainty.
And that's the dead weight. Saying it could drag on through FY2027 just solidifies this view that the big payoff, the clean, high-margin data business, is a multi-year story. And the market is just not that patient right now.
Okay, so if we take all this dissonance, the undervalued core business versus the very clear multi-year drag, and we distill it into a trade idea. And remember, this is purely a thought experiment for the listener. This is not financial advice.
Not financial advice.
Yeah.
But if we were pitching an idea to capture this specific tension, the thesis would be pretty simple. The core 52% gross margin business is robust and undervalued, but the company is being rightly penalized for the cash burn and the uncertainty of the Correlia timeline.
So you have to play the timeline. How would you structure a trade around that?
I think you'd have to use a structured approach like a calendar spread or a pair trade. The idea would be to short the equity for the next, say, 12 to 18 months. You're playing the narrative that the Correlia talks drag on, cash burn continues, and the stock gets punished for that near-term friction.
So you're essentially shorting the market's impatience.
You're shorting the noise and the drag.
Right.
Correct. And at the same time, you build a synthetic long position. Maybe deep in the money long-term call options, but they're anchored to the valuation multiple you expect after the Correlia spinoff is done.
So you're targeting, what, 2027 or 2028 expiration dates?
Exactly. Lets you hedge against the near-term OpEx worries and the volatility while still keeping full exposure to that ultimate strategic inflection point when this thing finally becomes a cleaner, high-margin, data-focused business free of the Correlia drag.
That is a fascinating way to play the operational strength against the balance sheet drag. So to wrap up, Champions Oncology, great execution in Q2, robust growth, fewer cancellations, and what looked like a durable 52% gross margin in the core business. Their future is all about that technical moat and radiolabeling and the data platform push with their new GM, Dr. Farid.
But the final thought we'll leave you with is this. Management signaled cautious optimism, a gradual recovery in new bookings heading into calendar 2026. Is that gradual timeline enough to overcome the short-term pressure from OpEx and that very long, multi-year timeline for the Correlia fix? How much patience should investors really commit to a pivot that might not spit out clean, positive free cash flow for 2 more fiscal years? The answer to that question is really what's going to determine where this stock goes.
That patience quotient is the whole game here. Thank you for joining us for this deep dive into the Champions Oncology earnings call. We'll see you next time on The Deep Dive.